Thank God it's Thursday, everybody. Hi, Michael, Patrick, Bran, Sinatra, AJ, team. Everyone doing okay? How are my team? How are my teammates?
Morning. All good.
Morning. Okay, so hey guys, so I saw your Skype Stel, as we're approaching a trend break in the S&Ps. It's that little cartoon where you had some guy talking about all the reasons that there'd be problems with the market, and that other little character would just say BT what? Oh, BTFD.
Buy the friggin' dip.
Yeah. So what do you I
Pretty
bring
sure
it up.
F meant something different.
Huh? Yeah. Anyway, it was so easy for all those years. I don't know if it's going to be like that this year. Here we are at a trend break. Not quite. It's about 41.11, and 41.11 is important to me because all traders look left, and the way I do it is I look for weekly reversals. 2-week reversals. So the close we had 2 weeks ago was 41.11, and coincidentally, like all things in technical analysis, there's got to be just coincidence. It's coming in, the off numbers coming in around the trend line with a day left. So pretty important day, I would say, in the S&Ps. And what set off risk off, guys? Is there any news?
I haven't seen any, no.
That makes it more bearish. Okay, so I don't know. I think BTFD can buy the dip. Let's see, where should they buy the dip? How about down here at 32.30? That's where you could start buying the dip.
That'll be a big old move.
Huh?
A decent move.
So
we always want to buy it. We always want to buy it at 32 when it's trading at 41. But when it gets to 32, everyone puts their pants and wonders why it's at 32.
You're right. It's going to be really hard to get long should we ever take out the October low. So anyway, we'll see. Dollar, not giving it up, not performing either. To me, we're trading above this trend line, but we're not exactly coming out of here. To me, it's a coin toss about the dollar. But hey, go Kman. So 101.60 by tomorrow at the close is a 2-week reversal in the dollar. So that'd be interesting. You get 2-week reversal in the dollar, 2-week reversal in S&Ps, although there's still 13 handles above it. Oh, hey, Kman, how are you today, bro?
Good. For the time being, let's call that a range.
Okay. Home on the range.
Oh yeah, that's
here in the antelope.
I'm always trying to recall songs to put in the chat room.
Yeah, don't give him any more ideas. His ones yesterday were terrible, Dale.
Anyway, so a range in the dollar, range in euro.
Yeah, exactly.
I don't know if you still think the yen's a range, or can we call it a trend yet?
I wouldn't call it a trend before we know what Bank of Japan is doing next week. But yeah, I mean, you call it's going
not
up.
a range, is it? You could say anything's in a range.
Trade, maybe.
Huh?
Short-term trend, maybe, since the lows.
Right. Okay. All right. So we'll see. I guess your first warning sign is, closing back under 34, which was, this prior high and a pretty good
33.80, 34 is a big level.
Right. So
but
continuation.
As I was also saying in the room, it's the first day in nearly a month that we closed above the daily cloud. and we retested it this morning, and it seems to be holding. But the main thing really is that, especially in the European mornings, euro has still been very big on the cross side, and that's playing a part in what we are seeing in dollar-yen as well, right?
Hey, you get off of my cloud. Don't hang around with. Keep going, man. I'll find another song in your.
Yeah. You're like me. You're like me. Must be a dinosaur thing.
It is. Oh, hold on. My left leg is stuck in the tar pit. Let me get it out of there. Anyway, so the metals.
Yeah, but
Braga put something up.
Today we are going to really have the first data out of the US. So perhaps, and then tomorrow we have PMIs and whatever else. So perhaps we are going to see a little bit of a move in dollar pairs. Let's put it that way. The rest is mainly the other side of the pair doing the work really right now. So yeah.
And so far that 360 on the 10-year has capped it, right? So that level looks pretty important to me. Look left, So it looks like the yen, analogous to the yen needing to hold that 44, 43 and a half for this trend to continue. I think it has to hold 350 on and
Two
pull
as well.
back in yields. What's that?
2-year yields as well yesterday hit a bit of a
Okay.
level around the 4.26s and couldn't get through.
Okay.
But Blake's going off today, so we need to know what time that is, because that's when volatility, the VIX will go to 50, and
I was just waiting for my cue. Waiting for my cue.
Actually, the VIX looks like it's coming out of here.
Well, you guys are going to have to stay up for Asian trade, because right in the thinnest part of Asian trade, right when, Kman, probably right when you were rolling out of bed when you lived in Tokyo, trading at the bank desks, that's probably when I'm getting on the plane today. So
time it for the CPI data tonight out of Japan.
I want to try to. It should be fun. Anyway, I'll back off now. I'll let you guys finish your conversation. I'll jump in.
We're finished.
Yeah.
Oh, you're finished?
Yeah, we wrapped.
I'm sorry. I was just I was
in the middle. It's all yours.
Oh well. So I'm sorry I missed the very beginning of this conversation, but can I go ahead and just point out where the S&P is at and
see, you missed it. I was talking about the trend break. So go ahead.
You think the trend break? Do you think it broke?
No.
Oh.
We're at 41.10 it breaks.
Oh, 41.10. That's interesting. I just wrote Dale, and I know you don't get an opportunity to read all the analysis here. I was looking at the 41.15 level, and that's the channel break. Okay. And this is our S&P update inside here, but you can see there's our channel support. But it's not just what's happening in the S&P. It's what is happening in the FX market. I think is kind of leading us.
The dollar coming out of here.
Well, here's the thing. Earlier this morning, and this is I have to put myself in the shoes of European traders. We got a couple of buckets. You got European traders and you got North American traders, right? Yes. So when I wake up in the morning, it's when most of the North American traders are waking up. But if you're in Europe and if you're in Ryan's shoes, you're in Kman's shoes, you guys are pulling profits. You guys and gals are pulling profits and kind of taking stuff off before I wake up. I mean, that's just what you guys do, right? I mean, Ryan, Kman, that you guys do that. Like, you're like, oh, hey, we've had a nice move in this hour. Let's go ahead and pull something off before these Yahoo Yanks get in front of their computer, right?
Oh yeah, got to get out of Dodge before you turn up.
Yeah, you're right. I mean, me before them. I mean, that's the attitude, right? I mean, that's the same thing that we think as North American traders before Asia comes online. You start thinking, what's Asia going to do? based on the data and blah 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 blah. So soon as I got in front of the computer, and just before I got in the computer, or just before obviously I'll pull up quotes as I'm grabbing my cup of coffee, heading to my desk. And what we saw some dollar weakness come through, and you can see it, in a lot of these pairs. You can see like the sterling was recovering, the Aussie was recovering, and when you see the Aussie, and this is what I was looking at right here, just so everybody can see it. When you're looking at that, when you first step in, and like, okay, I'm going to be in front of my computer, and then you got the Aussie recovering, not so much in the euro, but you had a little bit. That's thinking, in my opinion, you're going to see some risk on. Oops, we're going to come back to that. You're going to see some risk on, and Europe is preparing for another buy the dip day, right? As the S&P was right on support, and this is right at the same time. But now something different's happening. You're seeing the dollar really strengthen at this moment. And you're seeing us really challenge the support, as Dale, you were just talking about, here in the S&P. And so I think the dollar is really suggesting at this point that we are at risk of seeing a little bit of a reversal in risk. Now,
the dollar wrecking ball is now swinging back and forth.
It is
between asset classes, knocking down buildings.
Let's not forget, Dale, that everybody and their mother's brother's uncle is and my cleaning lady, by the way.
I brought that up in some of my stuff. I said, Blake's clean. I go,
she's bearish dollars. my cleaning lady, that English is her second language, is bearish dollars. So just so you guys all know that. Okay. And the thing is I know, and I'm joking, but not joking. I know that a lot of people are bearish the dollar right now, and it's a scary thing if you think. And I'm just going to give you my longer term S&P, thesis right now. ForexAnalytix traders already know this because we talk about this, quite often on the morning edge and daily roundup and stuff. That's when I get my my rants on, when I get to talk to our traders one-on-one. I start really, talking about different things, ranting about the markets, and we have like elongated conversations. Anyway, I feel that the S&P is basically doing this. If you think I'm a long-term, like, oh, we're gonna be, melting down and having another crash, I'm not in that camp. I just really think that the S&P is, little richly valued at this point. And I think, we could very easily be trading back down at 3,800 by the time we reach fall, so I think this range is very doable. So when you're at the upper end of your range, and you're in the middle of earnings season, you're on the cusp of sell in May, go away in a seasonal bearish trade, as it is for the equity markets. Then you have, we know we're marching right into a recession, and you already know the seasonal is sell in May and go away. So how many people are thinking, well, let's sell April 15th and go away? How many people are saying let's sell April 20th and go away, which happens to be today? You know what I mean?
Yeah.
So remember, when you trade and when you time markets, it's me before you, not me after you.
It was supposed to be such a bullish month that it
is. Of course it is. But again, we
11 handles on the month.
We are all looking at what's ahead, and we know what lies ahead. We all know. I mean, innately as investors, we know what lies ahead in the next. The question is, is it the next 6 months, or is it the next year and a half? Globally,
a lot of bulls out there still, though, Blake.
There are. I mean, the mainstream media likes to talk up the idea that we're going to have a soft landing. But do you guys really believe that? Let's go around the horn and see what you guys believe. Kman, I heard you earlier when I turned everything on. What are your thoughts about risk in general at these levels?
No, that's a good question. It's really a good question because I see different things when I look at different instruments. When I look at the equity markets, I think there's a risk for it to go lower, but then risk in the FX market doesn't trade the same at all. We are rather trading one currency versus the rest, or a couple of currencies versus the rest. Yeah, I do think, but I've said it in the start or even end of March. We were saying like, oh, April comes early because they are buying everything. And then I said it as well. You look at the middle of April and the party is going to be over. And also, let's not forget we still have OPEX in the mix, so then that may trigger flows that could make the picture a little more muddier. But yeah, yeah, risk off. I don't know if we're going to have a full risk off. Real data are going to confirm it if we are seeing it. But yeah, I'm more tilted to say we are going to see risk off coming. The thing is, we've been expecting that for quite a while, and there's a couple of pillars in the economy that hold up, which are preventing risk to really come off dramatically, right? Like the jobs market, and then we have seen a bit of turnaround as well in some other indicators that were supposedly bad, but then failed to put a double month of bad numbers in. So yeah, I'm still, the jury is out. Really, for me, the jury is out.
You know, I was talking to my and I'm glad you brought up the job market. I'm going to give you some anecdotal evidence, which really is worthless at this point, but I'll tell you guys anyway. Talking to my nephew, and he is he left his job because he wasn't happy at his job that he had for the last 3 years. He goes, and I'm like, oh, so, you know, how's your job search going? He's like, yeah, you know, it's fine. You know, he's like, I'm you know, he goes, but I can get a job anywhere. That doesn't even matter.
Yeah, but
I'm like, okay,
it totally
all right, good.
depends.
Good to know. What's that?
It totally depends on qualifications, though, right?
Yeah, but the fact of the matter is that here, this is a young man that's actually not really super qualified to have any job, but he says he can get any job. And when you know, is the laissez-faire attitude regarding the jobs market really suggests to me, and it's not just him, I'm just giving you this conversation that I had actually the other day, is that I think the jobs market it may stay relatively tight, but I don't know how tight. I mean, you've got a lot of employers that have really invested a lot of money getting employees back online, but when an economy slows, they're just going to cut the fat really quick. And a lot of tech companies are. As another example is my niece. She's a developer at a Silicon Valley firm, and they've lost half of their employees, and she feels none of them are coming back due to AI. And she's a coder there. So, you know, there's a lot of that going on. And anyway, the thing is the jobs market is the linchpin. That's going to be the thing that a lot of people are going to be thinking. Let's turn our attention to Steve, and thanks, Kman, for that. What do you think?
I want to say one thing before we turn to Steve.
I'm talking to Steve first.
You said laissez-faire. What the hell is that? You mean laissez-faire?
Yeah, laissez-faire.
Stelios, how do you feel about the equity markets here?
Good question. I've been listening to what you guys say. For me, the big picture is very simple. We had the game changer in the 2008 crisis. That's when central banks came in. They said, right, we're going to cut rates to zero, QE. We're going to be saving the world. This is what they did exactly during COVID, which, let's face it, okay, it was an issue with employment, but it was always going to be a short-term issue. Unfortunately, because I do not trust governments and central banks, I think they're going to do exactly the same whenever the new kind of crisis unfolds. This is going to be a banking crisis, it's going to be a real estate crisis. I don't care. So my view is that, yes, we will get a dip in equities, but it's going to be, you know, I was saying on our Skype chat this morning by the BTFD, I think we will go lower in equities. Not right now, I don't think, but I think we will go lower. But that will be once more a I don't want to say generational, but it's going to be a buying opportunity of you know,
of a lifetime.
Of a lifetime, yeah.
It's the best valued stock market ever.
Simply because they're just going to be flooding the market with credit and cheap money and everything. That's what they know how to do. And
I agree with Stelios. I think they're going to keep playing the same tune. They're going to keep following the same playbook until the playbook breaks the system. And then they will all, you know, be like, oh, you know, perhaps we should change the recipe. But until...
What's a broken down system look like?
It's going to be when the problems created from following this recipe are going to be become the focus of the market. So when the remedy becomes the problem, then the remedy will have to change.
So you're saying basically when the Terminator rises from the ashes to take out humanity, that's when the markets are going to change.
I'd be a seller.
Okay, so you know the great commentary there. I am not so sure, and this is where the question mark comes in, because I agree with you guys. I mean, you know, central banks, you know, it's I use the analogy in the ForexAnalytix chat room the other day. If you guys don't know what the ForexAnalytix chat room looks like, you can see there's our S&P room. Somebody's talking to me here. That's why it's red here. And you can just see some conversations that we're having. But in the ForexAnalytix chat room, I was talking about the Fed they accomplished what they needed to accomplish right now. They've basically like they expended every bullet they had in their revolver, right? Their pistol, their gun. But they have actually reloaded the entire revolver, every chamber, and they're ready to go. Like literally bring on the next firefight, because they have bullets to expend at this point. They have bullets to fire. Right?
I don't think that's an accurate description of the situation, Blake. It looks, an initial easy read could be what you're describing. Somebody just plainly looking at the numbers can say, oh, you know, we're going to be at 5% rates, right? We haven't been at 5% rates for quite some time. So yeah, there is a lot of room to cut from here, right? And that's going to be extremely helpful to the economy.
I don't think it's going to be helpful to the economy, Steve. You're not going to move the needle if the Fed adjusts rates by a quarter. What you are going to do is improve sentiment in the equity markets.
That is very true.
Where you have to discriminate and understand the difference between the stock market is not the economy.
No, it isn't. Of course it isn't.
No, but that's what everybody, especially newer investors, make that you know, that error of saying, oh, stock market's up, the economy must be good. No, but a small cut in rates from, you know, let's just say we're around 5% and the Fed's around 5%. Things get a little hairy next year, and if they cut rates to 4.75, stocks will enjoy it. It ain't going to make a diddly squat to the economy, right?
Yes, that is true.
So
but the thing is that rates is one part of the equation. There is another part of the equation, which is the balance sheet, and that's where you actually see the problem, because rates did manage to go up, albeit I'm afraid it's going to be very temporary. The balance sheet, though, is not shrinking. Every time, this is the second time they've promised that they're going to shrink the balance sheet substantially. And every time they start shrinking, this effort manages to last a few months. And within very little time, the balance sheet is at new highs. And in my opinion, we're going to see the balance sheet expand further and substantially once we get the next recession.
Oh, that is, and you know what? That's a totally elongated conversation. We have only about 6 minutes. Steve, I appreciate your thoughts, but let me
Bitcoin broke down.
Let's get some setups in here really quick. Ryan, I wanted to get your opinion on equity markets risk, because That was my original question about 10 minutes ago. Ryan, what are your thoughts about buying risk at these levels?
No, not for me. I think you've got to play the wider ranges at the moment. So this is in the middle. You can go two ways. You can look for a proper break of 42s, or you can get in down to that recent recent support, 41s, 40, 72s. Is that on your chart?
Yep, 40, 75-ish. Yeah, right around there. Yeah.
Park your buses. Don't get stuck in the middle. You know, Kay put a comment up, a fair valid comment in the chat room earlier, saying that this sort of market can suck people into stupid trades. So park your buses at the decent levels, and if you need to, just sit back and wait for them.
A couple things I want, and thanks, Ryan. I appreciate that. Did I miss anybody? Is Greg here? I'm not sure if he's popped in today. No, he's not here.
Greg is not here.
Dale, I want to get your opinion here in just a minute, but I want to show you guys just a few things. Like for me, when I'm trading, I'm looking for, it's always looking for clues, right? It's like every morning, it's Dale and I get it. It's 4 a.m. and you get this big jigsaw puzzle thrown at you, from overnight price action and all the headlines and everything else. And you go perusing through all the headlines. You jump in our chat room. You go, okay, well, what was posted in the news and research room with the headlines, and Ryan and Kman are really good at like posting all the headlines and things that are happening. So we go running through all that stuff, and then we're putting together the puzzle pieces. And the thing is, there's like a few that don't fit right now, and one of them is the U.S. dollar, Norwegian krona. Now, Stelios, I know you wanted to short it as we're at 1060. We are at 1060, and it's not backing off. This is one of those currencies that really, if I start to see it rally, especially above the 618 retracement at 1064, we start breaking higher, and we are literally at our highs right now. We start breaking higher this morning, I'm going to be really hesitant about buying stocks. I'm just telling you right now, I'm going to be very hesitant about buying risk. That's like one of those puzzle pieces that's just not kind of fitting with the rest of, it's like, is this puzzle piece even part of the same puzzle that I'm looking at? Not really too sure. Dollar Mexican peso, we have been very, very unable to break 18 in a risk-on environment where everybody's chasing carry. So everybody's buying pesos right now as stocks have been going higher, but has it gone anywhere? The answer to that question is no. So when do the shorts get a little nervous?
No.
If you start to see that turtle stick his head out right there, then I'm going to start thinking, hey, I don't know if I really want to buy risk anymore. So that's another, again, puzzle piece. It's just really not jiving a whole lot. Another one too is, and I'm just going to leave it at this, is you got crude oil, which I'm going to say crude. Thank God I'm not trading it right now. But crude gapped higher, right? OPEC gap. Everybody thought we were going to fill the gap. So that's the first thing everybody's going to think. We're going to fill the gap. Great. Didn't fill the gap. Really screwed all the sellers. So we start rallying out of this channel resistance, and through resistance, you can see it right here, right? We start rallying through that resistance. We get all the shorts squeezed out. All the shorts got squeezed out. Then we do an about face, go the other direction, get everybody long on the breakout. Then we reverse the other direction and we start breaking down, trying to fill the gap now. So crude has pretty much screwed everybody on both sides of the market, up, down, and sideways. So now that it's done that, you start to see a sell-off in crude. I don't think it's going to be moving with risk. So if crude continues to deteriorate here, again, that's just another puzzle piece. I'm like, yeah, I don't know if I really want to be long stocks right now. So those are just a few things that I'm looking at that I think that should be on your radar as we head in. And well, I got a few other things too. I talked about this last night on the trade-off, and I know it's helped by New Zealand CPI. We went right up to channel resistance, by the way. Everybody knew that, I was targeting up here. But we are in breakout territory. So these are pairs, like these cross rates, Euro Aussie, Euro Kiwi, Pound Aussie, Pound Kiwi, they all look better and they look strong. And in a rising risk environment, they shouldn't. They should actually look not so good. I know we have we got
data.
Just a few. few seconds to the weekly unemployment claims, and I don't think we're that far away from seeing these unemployment claims get a little, start to look a little weaker. So let's keep an eye on that. And Dale, before we go, I wanted to ask you about your thoughts about risk, but let's see what happens here in the data. Sorry, I need to hear the data. Ooh, jobless claims. Starting to weaken a little bit, not much. Wait till that number hits a three handle. We start to see, 300,000.
Yeah, it's a little bit on the uppy side. We've been running sort of 190s, 200s for the last few months, and now it's just creeping up a bit. Oh, Philly Fed worse. 31 minus
31.3. Oh, that's not good.
Ooh, that's not going to be. That's not good.
New orders is down. Prices
stocks like that though, right?
It's a new normal.
Bad data is good until it's not. And then
yields, they took another pip out of the yields. Dollars reacting a bit. The metals like the number. Gold like
look at the S&P. The initial knee-jerk reaction is I'm going to go higher because the data is bad.
Yeah.
The secondary reaction is, wait a second, that's really crappy data. Like, why am I buying stocks here? So that's it's that things don't change.
Narrative
changing. A flick of a switch, Dale. It's not like I'm walking into the kitchen and I flick on the light and I say, "Oh, risk now reacts differently."
No, you're on a battleship. That takes time. Yeah,
takes a little bit of time. Hey, Dale, before you go on to your interview, what's your thoughts about buying stocks at these levels? Because I wanted to get to you as well.
Okay, Blake. I've been showing things like cat and deer and semiconductors, and I've been bearish. I'm in puts out into September on a lot of different issues. I'm bearish, and I'll lift them if we close over 4,200.
Okay, fair enough. And I want to, I'm just going to reiterate my thoughts here. Look, I'm not looking for a complete meltdown, but I sure as hell wouldn't want to be buying it at the range highs here. I think stocks are going to be in a bigger range longer term, and I wouldn't be surprised if we're at 3,800 by fall. And
pull it down the box, pull the box down a little bit further down. Keep going. Go all the way through the RSI.
Oh, okay. So we're gonna take us down to 2,400. Is that where we're going? I'm joking. We're not gonna do that. All right. That. Yeah. But I do think we're in a bigger range, and you just got to trade the range. So be real careful chasing risk up here. I think there's a lot of, like I said, puzzle pieces that aren't really fitting in. And guys, let me just mention before Dale takes over. Remember, ForexAnalytix. Try it for a day. Or try it for 10 days. It's only $1 to try it out. Come join our chat room, because we have probably one of the most active trading communities here. A lot of, even on days where it's been dead, like volatility's been dead, like the last week, you guys all know that, we still are chatting about everything, posting charts, setups, what we're looking at, trades that we're taking, not just us. I'm talking about the entire community. It's not just the Ryan show or Kman show or Blake show, or it's everybody's in there being involved. So get involved, be part of the ForexAnalytix community. We'd love to see you there. All right, Dale, I'll let you take over. I know you have an interview. I don't know if it's with somebody new. I don't recall the name.
New, but I hope you have a great trip, Blake.
Yes, I will not be around tomorrow. So good luck with the stock market down 10% tomorrow. Joking.
And good luck with the tournament that you're going to.
Thank you. It's just a showcase, but I'll be there. I'll be there drinking beer on the sidelines. So
good father. That's a good father. Drunk. There's my dad. No, that's not him.
Yeah, there's the drunk guy. Oh, that's my dad. Just kidding. All right.
And team, thank you very much, guys. Talk to you all
later.
Guys.
Cheers, Dale.
Cheers, guys. Yu Meng, welcome to F.A.C.E.
Hi there. Can you see me and hear me, Dale?
Yeah, I can see you. I could hear you.
Great stuff. Thank you very much. I've got a little presentation which I'll share with you in a minute, if that's all right. But first, I just wanted to say, listen, I've been listening to you guys for about 3 years now, and I think it's fantastic what you guys all do. All the team, all of you guys. I feel like I know all of you because I listen to you every day and everything else. And it's really great macro color and very, very, very insightful and useful. And it's helped me a lot being in a very specific part of the market, which is the credit market. But just getting the macro feel has been excellent. Thank you so much.
Oh, well, it's rewarding to hear. Our mission statement's to build up and edify traders every day. Yeah. Let me just throw a little light on the situation. I'll be right with you.
Is he going to put 10p in the meter?
Let there be light. And there was.
Very good.
All right. So I went through your stream, and I notice you have a lot of interest in physical fitness besides the markets. And you mainly retweet other people's stuff. Are you a trader? What do you do in the credit markets?
So, I mean, Twitter has been more just it's a tool for interests and and learning about the markets. And I think some of there's a lot of nonsense on FinTwit. There's also some very good color. And I'm a portfolio. Well, I have been a portfolio manager for 15, 20 years, working in the credit markets. And the Twitter is useful as a research tool, I think, sometimes compared to the research we get from sell side, etc. It's a new view. And the way I've always traded credit, and I've been working for the last 10 years. I was based in Ireland as a head of credit for an Italian asset manager, and some of the macro color I get from you guys and everyone else has been very, very useful insight. And I've always traded credit with a very the very top-down macro feel to it. Of course, I go in and pick the instruments that I want to pick, etc. We'll go through that. Shall I just start my presentation and we can just take
sure,
if that's all right?
Yeah.
Let's have a look. See if I can find it. Yeah.
The share button there. You got it.
There we go.
Okay. Well, thanks for preparing something for us.
Oh no, it's pretty simplistic, but I just thought one of the things that we have with and I'm sure plenty of people that will listen to this, and some of you guys will be very developed and know about the credit markets. But often when I hear about credit, again on Twitter and in general wider senses, there's not a great understanding of how credit spreads operate and credit spreads work and the credit market operates. And people talk about H/G and LQD and say, look, credit's blown up. But there are really two components to a corporate bond. One, as we know, is the underlying interest rate curve, government bond curve, shall we say, and then there's the credit spread, the credit risk that sits above that, which is basically the risk for a particular issuer. And typically, a lot of people in the credit markets will trade credit, but will strip out the government bond risk or the interest rate risk and just trade that move in credit spreads. So I think sometimes we find that people say something's like, if you look at something like an LQD over the last year, the impact of the rates move has been so much more substantial than the credit moves at times. So I thought I'd just use this as an opportunity to talk about some of the moving factors within that. So if we go to the next page, very simply, that credit spread that sits above the bond curve is a function of two things: the probability of default and the loss given default. So par minus recovery. So what we're typically doing, and that spread essentially is basically derived by the market. So we almost often, the market buyers and sellers will derive what the spread is, but and then from that we calculate an implied default probability, and we make assumptions about recovery rate as well. So in the simplest example, if a recovery rate is 100%, theoretically the spread should be 0. Does that make sense? Just in sort of an idea of how we calculate that credit spread and how it operates and how it theoretically operates in the real world?
Yeah.
So that's that's what it is, but obviously becomes more complicated. And I know you guys and everyone talks about inverted yield curves when it comes to yield curves.
Where we're at now. Because
exactly right.
That's where we are. Okay.
Yeah. The interesting thing is when it comes to inverted yield curves, when you're thinking about it purely from a credit space, is we are then talking about the fact that the short-term implied probability of default on a company is significantly higher than if we go out in time, which says the company's got a very high chance of going bust, of defaulting. If it can survive 2 years, if it can survive 1 year, it'll definitely survive. Well, much higher chance it'll survive 5, 10 years, etc. And typically, again, whereas this, inverted yield curves right now in government bond world are a function of what recession is. When it comes to credit curves, this is what it means. It means, we're talking actually about the default risk or the higher probability to default of a credit going bust. But most of the time, credit curves sit normalized. They'll sit with, the further out in time you go, the increased probability of default, normalized credit curve, etc. But there's just the basics. So, we live in this world where credit curves may be flat, they may be normalized most of the time. And in some cases, of course, as we get to a situation where a company is getting more closer to going bust or defaulting, inverted yield curves come into play. So this is a sort of simplistic example of what happens there. So this is what I really wanted to talk about, is how people make money in the credit universe. Is that something I can go into a little bit more? That's
Sure.
all right with you?
Yeah.
Yeah. So of course, the most, one of the main things with credit, and just like we talk about with companies, et cetera, in the stock markets, are the fundamentals, improving credit stories, downgrade possibilities, default risks, fallen angels, all these kind of things. But what I think is more, if you're an asset manager out there, or a credit portfolio manager, or whatever you are, whether you're buy and hold, whether you're an insurance company, whether you're Continental Real Money, most people look at things on a fundamental basis, pick the credits that they like, etc., and then they buy the instrument they want of that, and they sit on it. Some will be buy to hold, some will be mark to market. But how does someone consistently make money in the credit markets? Well, obviously fundamentals are very, very important. You need to know the credit stories that you're getting involved in, whether you're picking the winners and losers, but just knowing. But a lot of the time, credit spreads, and I've been trading investment grade credit most of the time that I've been in the market. If you've got an Apple or a BMW or a Microsoft, most of the time we're not talking about these companies going bust. They're not default risk, etc. But their credit spread does move around during the course of the year.
Not yet.
Not yet. We haven't got there yet, But things change, right? There's a lot of names out there, and there are names that always are more risky than others, but a lot of investment grade credit doesn't really default. We've seen that. But they do move around. In the course of a year, credit spreads do move around. And I think a lot of participants miss this fact. And what causes them to move around? Well, technicals. And when I talk about technicals, I'm not talking about necessarily
Charts.
RSI and Fibonacci and things like that. In the credit world, it's slightly different. The technicals are simply a function of often flows. You've had Chem Carson on your show before, and he often talks about technicals and flows and how they apply to from the option market into the equity markets. But flows are such a big part of how credit spreads move in the course of a year. If you can look at things like the seasonality around supply, because a lot of corporate bonds are issued. There are seasons where companies have a lot more corporate bonds than they have, than they have one equity, universe of corporate bonds. Times of the year when rates sell off and insurance buyers come in and pick up credit spread, and that causes credit to compress. At the moment, we're in a phase where, even though I'm not in the market myself at the moment, we're in a phase where the search for yield has been so strong, because first time in 8-9 years we're seeing such a wider yield, etc., that people come in, they buy the bonds, and it's causing credit curves to actually become very, very, very negative, almost very expensive, because the yield buyers are outweighing the spread buyers, or the guys who trade stock on spread. And these kind of technicals and these kind of flows affect the market. Liquidity has a massive impact on it as well, because
let's stop there. So I'm sure in your journey, you looked at the T-bond market here in the U.S. You lay off risk there. Liquidity has really dried up. It used to be the deepest market on the floor at the CBOT, and used to be able to get things done for a 30-second, the bid between the bid and offer.
That's right.
And now spreads have really blown out, and there's not as much liquidity in there. We did have a major credit event in the UK when we had to have central bank intervention to save the gilt market. And it looks like we're going to have gilt pension problem 2.0 coming up, because rates are rising there again and look like they could go to new highs. So have you ever lived in an environment like this? Because I can't remember the Fed on a course where they accomplished, or whatever you want to call it, raising rates that dramatically in such a short, compressed period of time, when people own paper in Europe with negative rates and the 10-year here at 2. Don't you think we're set up for a lot of solvency issues and the tightening of credit now after SVB? Isn't it kind of hard to be a bull in the credit market?
Yeah, I mean, what you guys talk about every day, and in general, the consensus is out there, is that that we've had such a huge move, such a quick and huge move in the rates moves, and we haven't really seen it felt. We've seen pockets of it. Like you said, you've talked about SVB, you've talked about what happened with the gilt crisis, etc. But they've kept on they've been able to keep on going because these have been resolved one way or the other. Liquidity injections of various kinds have been put in. But have we really seen the impact of this? I can tell you just on the ground anecdotally that there doesn't seem to be a recession in the UK. I'm here in the UK. It doesn't feel to be. You go out and about and people are still spending money. Are people still, just from a real economy point of view rather than the markets? No, there's no sense of it as yet. And maybe there's a fallback. I know, in the UK in particular is an economy where, there are much more mortgages that are short dated, fixed rates, which people are moving into higher rates, and we haven't really seen it. I generally won't be surprised if we've just backloaded the problem, and it'll just keep on going until ultimately it does break in a much more angry way. And the markets, we know, are not the economy. And again, we talk about the markets, and I think what we've still got is this kind of just junkie mentality, because the yield, certainly in the credit space in Europe, I'm talking about the sterling market and the euro market, yields were so low for so long that the fact that we've suddenly had this explosion in yields has just meant fill your boots. The European, like I said, I'm out of the market at the moment.
It was electric shock therapy.
Yeah, exactly right. And it feeds through, and even if people are just buying the short end of the curve, they're getting much more attractive yields right now than they've had. The same concept of me and you putting our money in an Apple 4.5% savings account. Well, if you're an investor, you're putting it into 1, 2, 3 year European corporate bonds at the moment, where you're getting 3, 4, 5% in quality names, which you were not getting. So the credit spread almost becomes irrelevant. It's the yield curve that's been so dramatically affected, and that money is just being put to work. And there is still so much money out there that needs a home. And we've had, the backdrop.
You want my address?
Very good. And we've had a backdrop.
Hey, move out. Yuming's going to send people's money here. I need some room to stack it. I'll convert it to gold. Anyway, you have a view on, does a dollar come into the picture when you're analyzing credit, currency risk? You pay attention to currencies?
Yeah, I mean, obviously there's a cross-currency effect, and there are number one, there's this idea of portfolio managers out there and macro funds that can basically look between dollars and sterling, or euros, and you can buy maybe a BMW bond in euros or in sterling, etc., and dollars, and you look at the cross-currency, and it varies. Cross-currency spreads move around over time, and it has an impact. And you'll typically find issuers, the smart issuers in the US, for example, when the cross-currency was in their favor, will issue into the Eurobond market, etc., when it suits them, etc. For me as a PM, my question was always, okay, fine, after cross-currency, a bond might be significantly cheaper for me, a BMW bond or a Volkswagen bond in dollars than it is in euros. But what's going to cause it? What's going to cause it to perform? Because I'm almost like a trader in my seat. I'm trying to see what's going to cause that the outperformance of it. I'm playing a relative value versus the other bond. I'm not looking at the yield and forgetting about it. So as a trader, you kind of look at it and go, what's going to make it perform? And I've generally found that with bonds that are issued into the dollar market, I never had the same picture or understanding of where those bonds were going to as opposed to what I can see in the euro market, where I can trade it much more and I can see the flow of it much more clearly. But yes, it does have it has an impact where issuers issue, and it impacts where people can buy them and trade them, I suppose.
Okay, so this chart you have before us, what's it telling you?
Yes, this is one chart basically going back to the concept of what I was saying earlier on about flows and technicals and macro factors. A lot of times people talk about credit markets are ahead of equity markets. This is just a graph of European credit spreads versus the S&P 500 over the last few years. And typically what I found is the correlation is very, very high. Spreads obviously rally when the S&P rallies, the opposite way. But my point is, you've often talked about turnaround Tuesday. And let's think of a hypothetical example where we sell off on a Monday, equities sell off on a Monday, Europe opens on a Tuesday morning, the markets are weak. Market makers in the credit market seeing equities sell off, and they just keep marking their bonds wider, their credit spreads wider. And then Tuesday afternoon, regular trading hours, the S&P hits the support, bounces off it, starts to rally back, credit starts to tighten because market makers mark the book tighter. And my point is that credit often, equities go first and credit often follows. Certainly in the European market, I found in my history. And it's not always that well known. Credit spreads will often react. Okay, they've got their own technicals away from that. But I found that as a process that I've used is if you're able to have a good understanding of macro and a good understanding of what equities are doing and other risky assets are doing, that is a very good lead indicator if you're trading a credit portfolio, which is again why I follow guys like you talking about the macro picture, because it's been so useful.
So if you can get the S&P right directionally, it gives you an edge when you're going into euro bond spreads.
Yeah,
how
correct.
to trade them.
Correct.
Okay, it'll tell you, so it's risk on, and it's not the bonds that lead. But you know what they did in the U.S. in last year? The bond market was even worse performer. Sovereigns, I'm talking now.
Yeah, sovereigns. This is the thing.
Then the market.
And I'd agree with sovereigns even in the European space. But the credit moves can often be linked to then what happens with risk on, risk off, right? They are essentially some of the same companies. And then it's a question of, but there are also second order effects. The fact that the yield curve inverted has an impact on buyers of credit risk, where they want to buy it, etc. So you've got to put all the pieces of the puzzle together, basically, when you're building a portfolio and things like that.
Okay.
And then it's about finding the best instrument. You can see this is just an example of bond versus CDS. These are credit spreads on a range of BMW bonds versus their CDS curve. And at the moment, cash spreads, credit spreads on cash bonds are significantly inside where the CDS curves are, etc. And of course, the CDS curve, CDS, as we know, is was designed as as a hedging tool, but has become a speculative tool for many years now, as you know about from the GFC times, etc. and things like that. So, and then it's a question of, once you've made a view on how you want to structure your portfolio, it's about picking the best instrument from where you want to be on the maturity spectrum, where you want to be in the cash, do you want to be in the derivative, from a technical point of view, from a flow point of view, market making point of view. We touched on it a little bit earlier on about market making and liquidity disappearing. Since the GFC, especially in the European market, we have had, the amount of warehousing that a market maker can have for corporate bonds has significantly shrunk. So as a result, you find we get these very gappy moves as well. And that ties in with the risk on, risk off that I talked about, where a bunch of dealers can all be long the same bond. It can be marked wider, and suddenly you might get 3 or 4 buyers coming in when the S&P holds support, and all of a sudden dealers are all taking out their bonds and we get major squeezes. And there just is the warehousing capability of the street is so reduced these days that it's a very gappy market.
Yeah. So it's a fragile structure.
Yeah, it very much is so. Yeah.
All right. So, during these last minutes, why don't you give us a look forward as to the landscape you see here, or do you have a view? You have a narrative of where rates are headed from here, and can you forecast if you like the bond market, what part of it you'd be looking at? Would it be junk if you think we're going to be HYG? If you think, go ahead.
I think this year, even though we've, credit spreads have rallied, risk has rallied, it's felt relatively firm. It's not been the same ball game as we've had in the last 10 years, of course, because of, the underlying rates are significantly higher than they've been. And I think in a way, a lot of the junk spreads have not performed so well. People have basically parked in quality because they've been able to get the yield in quality. Does that trend change? I don't think so. I think and I think you've mentioned the S&P at 4,200, etc., which is a real line in the sand number, has been for a long time. It's the top of that range that we've been in. Should we break out of that?
Yeah.
Let's see what causes that. I personally think that when the Fed pauses, which I suspect might be in June, we might get this melt up that's been talked about, in certain circles for a while. You might see all risk rally. You might see a catch up. Bank spreads, for example, of course, since last month have underperformed a little bit. Could catch a rally, and subordinated spread could catch a rally. But it doesn't change my bigger picture that a recession is coming. It's a question of when. There has to be a repricing of the amount of money that people are going to have disposable, etc., the real economy tiding with the markets. And we've been in a little phase. If I recall, and you might know this better than me, 2006, when the Fed paused, didn't risk rally for a few months before we actually started the recession talk, and then we started, they went from there. Like when the Fed typically pauses, or the central banks typically pause, is a phase where we see a bit of a risk on rally. And then the reality, and when you start actually seeing the rate cuts, things change to the.
Yeah, I think it took a year after they paused for us to enter a bear market.
Yeah, so we could be facing something like that. Yeah. And I mean, credit spreads, European credit spreads, just purely credit spreads. And I know there's a dichotomy within that index, etc. But we're still significantly wider than we were at the tights. When the tights, basically, we sat at the tights all through 2021 and touched that level at various times over the previous 10 years. So there's a long way still to go to the tights. But again, the market is a lot more nervous. I mean, it's been the most hated rally. You could say the same thing in equities this year. It's been a hated rally. So they could carry on. I would not be surprised when the pause happens that we do get a short-term melt-up. And then we kind of, let's address the picture after that.
All right. Well, Yiming, it was really a surprise. I didn't know what we'd be doing here today, but, I never would have known you were a bond trader from just reading your feed. And it's, to me, it's, you need people like that because I see all the complexity in your universe that you trade and appreciate you coming here. Do you have a business model? Is there any reason you're on Twitter? Do you want followers? How can we help you out here at F.A.C.E?
Actually, I hope you don't mind me using this moment to market myself a little bit. So, Twitter, like I said, I follow you guys on Twitter. It's more of a recreational thing for me as well as picking up information. I'm not using it as necessarily a business model. But I was a credit PM for 9 years, working for a large asset manager as head of credit in Dublin. I was in Dublin, Ireland. I've recently moved back to the UK for personal reasons. My father got sick, and I wanted to be closer to home. And I wanted to take a little break. I took about 6 months off. I've traveled, and I'm now back. And I am actually looking for another role. I'm looking for, if anyone through your network or people who watch this who are, are looking to employ a credit portfolio manager in the real money or the fast money space, or want to talk to me about potentially raising assets to build something, I'm ready to go again. So I was just hoping coming on here, presenting a little bit. I've got a very good track record with a sharp ratio of 3 over 9 years. So if anybody wants to speak to me or is looking to hire a PM, then I'd be happy to talk to them. So I hope it's all right for me to ask that.
No, it's fine. And your Twitter handle again? It's kind of unusual. What is it?
It's DUIN11. I think it is. I actually haven't even checked it. That is right. Yeah. It's there anyway.
And you don't have a website, so that's really the place for people to find you is Twitter.
Yeah.
Well, if I had a bond portfolio, I'd be talking to you. So I hope this. I hope that the seed that you planted turns into something. let us know. And really a pleasure meeting you, Umang. And glad our paths crossed.
Thank you, Dale. I really appreciate it. And thank you very much for all the stuff you do for all of us that watch you daily.
I'm rooting for you, buddy.
Thank you.
You're now my trading warrior brother, and I am rooting for you, Umang.
Thank you very much. I appreciate your time.
All right, buddy.
Thank you. Take care. Thank you.
You're very welcome. Guys, you could join the rest of the team in 15 minutes on the Morning Edge. Hope you enjoyed that. If you have interest in bond markets, or like, I don't even know how many people watch us. I find out when I bring on guests that people watch us. So get a hold of the guy. Seems sincere. Can't hurt to talk. And what is this 420 stuff? Okay. What is 420? What's the meaning behind 420? Someone tell me before I check out here. Ingmar? Oh, it's Cannabis Day. Oh, no wonder I forgot what it meant. All right. All right, Scott. Yeah. Do a bong for me too, bro. All right, Mike. All you guys have a great day trading. Let's see if the S&Ps can hold that trend line. Don't just count your pips, count your blessings, everyone. Love you too, guys. Adios.